Hey, welcome back to Compounding Quietly. 1,000 shares of SCHD sounds like a milestone, but most investors who reach that number don't fully understand what they're holding. Not in terms of what it actually produces, and not in terms of how to measure whether it's working the way it should. Let's get into it. SCHD is a dividend growth ETF. That distinction matters more than most people give it credit for. It doesn't hold companies simply because they offer a high yield right now. It holds companies that have demonstrated the financial discipline to grow their dividend year after year through different market conditions. When you own 1,000 shares of SCHD, you're not just holding a market position. You're holding a claim on an income stream. And that stream, if the structure remains intact, is designed to grow over time. That single reframe changes everything about how this position should be evaluated. Most investors track a holding like this by price. When the position rises, they feel confident. When it pulls back, they start questioning whether to add, whether to hold, whether to wait for something cleaner to happen in the market. The emotional state moves with the price chart, but price is not what SCHD is designed to optimize. Income is. So the more useful set of questions to be carrying around with a position like this is not, where is the price going? It's, is the income growing? Is it stable? Is it arriving on schedule? Here's what the numbers actually look like. SCHD currently yields somewhere in the range of 3.5% to 4% annually. On 1,000 shares at roughly $25 per share in annual dividends, that's approximately $2,500 per year arriving as income. Paid quarterly, meaning around $625 landing in your account every 3 months. That number might not feel dramatic on its own, but evaluating it in isolation misses the point. The right question is what that number grows into, and whether you have a clear enough framework to watch it compound without second-guessing the position every time the price shifts. The judgment anchor worth holding on to right now is this. If the income is growing and intact, the position is doing its job, regardless of what the market is saying about its price on any given day. Let's go deeper into how SCHD is actually constructed, because understanding what's inside, the ETF explains why the income tends to grow rather than plateau or fade over time. SCHD uses a screening process that selects companies based on dividend consistency, free cash flow strength, and financial health relative to sector peers. These are not companies squeezing out maximum yield at the expense of their balance sheet. These are companies that have the capacity and the demonstrated track record to raise their dividend through different economic conditions without jeopardizing the underlying business. That's why SCHD earns the label dividend growth rather than simply high yield. The goal is not the largest possible income stream today. The goal is an income stream that grows reliably over time, compounding quietly in the background while the market goes through its cycles. Here's what that looks like in concrete terms for a 1,000 share position. If the underlying holdings grow their dividends at roughly 8 to 10% annually, which is broadly in line with SCHD's historical dividend growth rate, the $2,500 in annual income today doesn't stay at $2,500. Run the math 5 years forward. Those same 1,000 shares with no additional purchases could be producing somewhere around $3,600 to $3,900 in annual dividend income. That's a 45 to 55% increase in income without adding a single share and without making any new investment decisions along the way. Run it 10 years forward. Annual income from those same 1,000 shares could be approaching $5,400 to $6,200. No new capital deployed. No timing the market correctly. Just the underlying companies continuing to raise what they pay, and the position continuing to collect it. Most investors look at a 1,000 share position and see a static number sitting in their brokerage account. What it actually represents, held with patience, is a growing income engine, one that works quietly in the background, regardless of what the market assigns as its price on any given day. Now let's talk about the emotional reality, because this is where most investors with long-term positions lose the thread. When the market pulls back, and those 1,000 shares are suddenly priced lower than what you paid, the instinct is to feel like the position is failing. The account balance drops. You start calculating unrealized losses. The natural impulse is either to exit to stop the feeling of watching value erode, or to freeze, waiting for the price to recover before doing anything at all. But here's the question that resets the judgment. Did the dividend get cut? If $625 still arrived in your account this quarter on schedule, roughly as expected, the position isn't failing. The price moved. The income stream didn't. Price movement and income failure are not the same thing. For a dividend growth ETF, the integrity of the income stream is the signal that matters, not the daily valuation the market assigns to your shares. Coming back to the original question, what does it actually mean to own 1,000 shares of SCHD? It depends entirely on what you've decided to measure. If you're measuring price, you'll feel uncertain every time the market moves. You'll be asking whether now is the right time to add more, whether you should wait, whether something else is performing better. The decision-making becomes reactive, driven by how the position feels in any given week, rather than by whether it's doing what it was designed to do. If you're measuring income, whether the quarterly deposit arrived, whether the amount increased relative to last year, you'll feel something closer to clarity. Not certainty about the market, clarity about what you're building. There's one more layer worth examining, and that's what happens when you reinvest the dividends, rather than taking them as cash. When the quarterly payment comes in and goes back into additional shares, the compounding mechanism shifts into a different gear. More shares produce more dividends. More dividends purchase more shares the following quarter. And when prices are lower, when the market is nervous, and your account balance is dropped, each dollar of reinvested dividend buys more shares per dollar than it would at higher valuations. This is why market pullbacks carry a different emotional charge for investors who have genuinely made income their primary metric. They're not watching a loss accumulate. They're watching the reinvestment work more efficiently than usual. The shares accumulated during a pullback will generate dividends next quarter, and the quarter after that, and every quarter going forward. The price at the time of purchase eventually becomes a historical footnote. The income those shares produce does not. That is the structural argument for staying invested and staying calm through periods of volatility in a position like this. Not certainty about where the market goes. Clarity about what you're building and why. 1,000 shares of SCHD isn't a destination. It's a reference point for learning how to think about a long-term income position. The investors who hold a position like this, with the most composure through difficult markets, are not the ones who predicted the volatility. They're the ones who changed what they measure. They're not watching a number on a screen, waiting for it to recover. They're watching a quarterly income deposit arrive on schedule, roughly as expected, and using that consistency as their signal that the structure is intact. That shift doesn't happen automatically. It requires a deliberate decision that the goal is to build a growing income stream, not to manage a price target. When that decision is made with clarity, the noise around the position quiets. The questions become more specific. Is the dividend growing? Is the payout ratio sustainable? Are the underlying companies still meeting the criteria that made this ETF worth holding in the first place? Those are the right questions for this kind of position. And when you're asking the right questions, the position gets the space it needs to do what it was designed to do. Compounding quietly investing that gives you peace of mind. If this video helped, subscribe and leave a like. I hope this becomes a small source of strength in your investment journey. The content in this video is for general informational purposes only. All final decisions and responsibilities remain with the investor. Thank you for spending time with Compounding Quietly today.